I want you to picture this scenario, and I want you to be brutally honest with yourself if this sounds familiar. You open your charts to start your day. You're scanning through your watch list, and suddenly you see it. A stock, a currency pair, a crypto asset. It doesn't matter what it is. It is absolutely launching. Green candle after green candle. Huge momentum, just ripping higher. It is undeniably a beautiful, strong trend. You know, deep down in your gut, that this thing is going higher. The momentum is obvious. But then, that little voice in your head kicks in. You know the one. It whispers, "Whoa, hold on a second. You can't chase it up here. Look how high it is." That's pure FOMO. You tell yourself, "I'm not going to be the idiot who buys the top. I'm going to be smart. I'm going to be disciplined." So what do? You act like the responsible retail trader you've been taught to be. You pull out your trusty Fibonacci tool. You draw it from the swing low to that massive new high, and you pinpoint that perfect golden zone, the 50% or the 61.8% retracement level. You set your limit orders, you cross your arms, and you sit back, feeling pretty proud of yourself for having such patience. You are waiting for the market to come to you, like a professional, right? But then, watch what happens next. This is the part that is absolute agony. The market dips, maybe a few pips, maybe a few cents. It pauses for a handful of candles, barely catching its breath. It doesn't even come close to your entry order. It almost feels like the market is laughing at your perfectly drawn Fibonacci levels. And then, it rips higher again. It explodes upward, leaving you completely in the dust, sitting on the sidelines with your hands in your pockets. You just watched the cleanest, most explosive, most profitable move of the entire month play out right in front of your face, and you made exactly $0. Why? Because you were waiting for an entry that was never, ever going to happen in that specific market environment. So we have to ask the hard question, why does this keep happening? Is it bad luck? Is the market rigged against you? No. It happens because you are fundamentally misunderstanding the environment you are in. You are applying rules that work for a weak market to a strong market. You see, we are taught in textbooks that trends need to pull back deep. We are taught that the market needs to breathe to be healthy. And sure, in a weak or average trend, that is true. But a strong trend? Forget about it. A strong trend does not need to breathe. It needs to run. Think of it like a freight train barreling down the tracks. It doesn't stop and reverse halfway back to the station just to pick up a few passengers. It keeps moving. This is the playground of the institutions. And if you want to trade like the 1%, you have to stop bargain hunting and start momentum riding. So today we are going to fix this. I am going to give you the exact blueprint to catch these moves. We call this the shallow continuation pullback. But you cannot just trade this blindly. You need a system. We are going to use a specific time frame funnel to stack the odds in our favor. Here is exactly how the setup works, step by step. I recommend using a very specific combination of time frames. Your context time frame should be about 10 times higher than your confirmation time frame. And your confirmation time frame should be 5 to 6 times higher than your entry time frame. So for this example, here is our stack. The 4-hour is our context. The 30-minute is our confirmation. And the 5-minute is our entry. Let's break it down. Step 1, the context. Go to your higher time frame, the 4-hour chart. You need to answer one question. Is the market in a clear breakout mode? You want to see a leg that has just started or is in the middle of its expansion. And this is crucial. Check your EMAs. You do not want to trade a move that has been stretched too far away from the moving averages. If price is miles away from the mean, the rubber band is stretched too tight. But if it's fresh, proceed to step 2. Step 2, the impulse. Drop down to a time frame 10 times lower, in our case, the 30-minute chart. Here, you need to identify a strong impulsive leg. This isn't a slow drift. You want to see price explode in one direction with large candles, minimal wicks, and absolutely no hesitation. This is your signal that institutions are controlling the direction. Now you wait. This is where 99% of traders get tricked. They expect a deep correction. They want that 50% discount. But the market only gives you a 20 to 30% retracement. It might look like a micropause, a small consolidation, or even just a tiny inside bar. Sometimes it is only 2 to 4 candles against the trend. If you are using EMAs, you will often see price retrace just to touch the 5, 10, or 20 EMA before continuing higher. If you aren't using EMAs, measure the last impulse leg and simply wait for that shallow 20 to 30% retracement zone. This is your hunting ground. Step 3, the confirmation. Now drop to your lower time frame, the entry time frame. We are using the 5-minute chart here. This is the confirmation most traders miss. You are looking for a clear continuation pattern, like a clean bull flag. You are watching for energy returning to the market. And here is what you need to see: a strong bullish candle that breaks out of the flag and decisively breaks the microstructure of the pullback. Listen to me closely on this part. This candle is the signal. You don't need a break and retest. You don't need 5 different indicators to line up. When a continuation candle appears in this specific context, the trend is ready for the next leg. Step 4, the entry. You enter immediately on the candle close. Do not hesitate. Momentum waits for no one. Step 5, the stop loss. Place your stop just below the shallow pullback structure. Because you are entering on a compressed, tight consolidation, this creates an extremely tight stop relative to the potential move. Step 6, the take profit. Aim for a 2 or 3 risk-to-reward ratio. If you want to actually master price action from the ground up, my course walks you through the entire approach, step by step. The link is in the description and in the pinned comment below. Now I know what you're thinking. But isn't this dangerous? Isn't this buying high? And this brings us to the final and most important point, the psychology. 99% of traders will never take this trade. Why? Fear. It feels reckless to buy something that has already gone up. It feels safer. It feels more responsible to wait for a deep pullback. But I want you to burn this quote into your brain. In trading, what feels comfortable is almost always the wrong thing to do. The masses want comfort. That is why the masses lose. The pros? The pros want profit. The pros are willing to feel the discomfort of buying high because they know the probability is on their side. But before you run to your charts, I need to give you one critical warning. There is a specific scenario, and you must know how to spot it. We talked about the shallow pullback being 20 to 30%. But what happens if price dips deeper? What if it pushes down to the 50% level or the 61.8% level? Your instinct might be, great, now I'm getting a better price. It's on sale. Do not buy it. If a market is truly in a momentum phase, a deep pullback is actually a sign of weakness, not value. If the buyers were truly aggressive, they wouldn't let the price drop that far. So, here is your safety valve rule. If the price breaks below the 38.2% Fibonacci retracement, the shallow continuation setup is invalid. Delete the order. Walk away. The momentum has shifted and the probability has dropped. We only want the trades that refuse to go down. So, let's do a quick mental rehearsal to make sure you have this locked in. Next time you see a chart exploding vertically, do not chase the green candles, but do not wait for the deep crash either. Step 1, check the context. Is the 4-hour chart breaking out and fresh? Step 2, zoom in. Find the impulse on the 30-minute. Is it aggressive? Step 3, the wait. Watch for that tiny pause. The 20% dip. Step 4, the trigger. Drop to the 5-minute. Wait for that one single candle that breaks the flag. Step 5, execute without hesitation. Stop loss below the flag. Take profit at 2R or 3R. This is not about being a fortune teller. It is about recognizing that fast moves have different physics than slow moves. You are essentially surfing a tsunami. You don't paddle out when the wave is flat, you paddle when the water's moving. So, my final advice to you is this. Stop trying to force the market to fit your textbook definitions of a safe entry. The market does not care about your textbooks. It cares about liquidity and momentum. Start trusting the strength, start trusting the shallow pullback. And watch how your trading results shift from waiting and wishing to executing and profiting. If you want more detailed breakdowns, more full setups, and if you want to learn my exact framework, make sure to like this video, subscribe, and check the links in the description for my private community and full trading course. Trade smart, stay patient, and I'll see you in the next video.